Welcome. Here we are at our very first ETF Spotlight here with Jess. Good to see you, Jess.
Thank you.
And we're going to be kicking this off every month talking about a single ETF that we have researched as to why we've got in our portfolio, why we don't, why we may add it. So we're going to kick off the very first edition with the iShares Global Consumer Staples. So Jess, I'm just going to bring that across onto the page here. And do you want to give a bit of background about it?
Sure. This is a position we've added to in almost all of our portfolios in the last 2 to 3 weeks. This specific allocation addresses two areas that we feel like are interesting and attractive for a variety of portfolios. The first is the sector. So this is specifically a sector ETF that allocates to consumer staples companies. This is your Kimberly-Clark, Procter& Gamble, Coca-Cola. But one thing that is unusual about this position compared to some of the other alternatives in the consumer staples space is this is a global consumer staples position. And for us specifically, this has been a strategic way to add to our European exposure in a sector where we feel more comfortable with the forward-looking opportunities. So in addition to the U.S. blue chips, you find in this portfolio Nestle, Unilever, Danone, and other high-quality global consumer staple allocations. So we've added to this specifically for the European exposure and for the sector exposure and consumer staples.
Now, just looking at this, Jess, I've got up on the screen the iShares Global Consumer Staples last year did about 6.7%. The year before, in 2013, it was up about 20%. This year, it's only done 0.24%. Do you want to talk a bit about that?
Sure. Well, from a performance standpoint, we're really looking at the forward-looking opportunity. This is a new allocation, so this isn't a position that we've held previously. And compared to most growth sectors, particularly where we took the money from to get this, which was actually at the end of July, we sold out of our technology exposure in the Nasdaq. This position will have underperformed in growth markets and expansionary markets. Consumer staples, which are more of a defensive basket of companies, tends not to do as well. So, and some of the flat performance this year, some of that has been the strong dollar for the non-U.S. part of this portfolio. And for Q1 and Q2 of this year, sort of before we saw the market sell-off related to China and other news, defensive sectors definitely underperformed growth sectors for the first 2 quarters of the year. That rally in growth markets was one of the major reasons we sold off our exposure to NASDAQ stocks and a couple of other positions, rotating into this position as well as a couple of others where we felt like we were taking a more defensive allocation,
Well, let's just talk a bit.
believing that we're near
Sorry.
the end sort of the end stage of a cycle.
Right. Let's just talk to that because I know, when we talk to our clients and we have these conversations every week, if not daily, with our investment committee and talking about what we're doing with selections. When clients say to us, "Why do we call this defensive?" What do you say to that?
There are a variety of reasons you refer to consumer staples as defensive. Part on a very practical basis is simply when you look at how people spend their money. So if you look at how dollars are allocated both at a corporate level and at a personal level, there are needs and there are wants, right? When we talk about budget planning, there are things you have to have and there are things you'd like to have. And consumer staples are the things that you have to have. Even if the economy is not doing well, you still need food, you still need paper products, you still need diapers and baby formula. These companies tend to do relatively well compared to other sectors where people can afford to make cuts. If the economy is slowing down or people are concerned about the forward-looking outlook, they're much less likely to buy the new iPhone. They're not going to necessarily, companies are not going to invest in new technology. They're going to take fewer steps towards growth, but they still have to keep paying the bills, and they still have to keep providing for basic needs on a corporate and individual level. So practically, that's part of why we refer to this as a defensive sector. The other piece is on a fundamentals basis, because I think people believe that these do better in part in defensive, in recessionary and late stage cycles. Historically, these companies in this sector has performed well under those market conditions. So part of what we're looking at is markets are cyclical, although every up and down movement feels unique. The reality is there are a lot of patterns in equity markets
Yeah.
as well as in fixed income markets. So we're looking at a period that markets have slowed down. We've seen somewhat of a correction. We've seen a sell-off in prices. And there's quite a bit of uncertainty going into Q4 now, with China, with U.S. jobs numbers that came out last night that were not very positive. And there's a lot of concern about the economy slowing down. And so we feel like this is a good allocation for where we're at in the market cycle.
So
And that's largely why we refer to it as defensive.
So when we've got companies out there like Apple with tech, and we've had pretty much. And while I'm saying this, let me just get the iShares webpage up. Pretty much since the GFC hit and bottomed out in 2008, this has had a pretty linear growth straight up, um, and that's been on the back of. And you and I have spoken about this. You've got your India, your China, still buying more of soap, razor blades, Gillette, Johnson and Johnson, all those sorts of things are still going to happen, even if mergers and growth doesn't happen in the next couple of years. And we're not going to see the same sort of double-digit growth we've had for the last 7 years. I think moving forward for the next 3 to 5 years. So it's getting clients and managing their expectations down to say things aren't going to be as building up as fast as we've had for the last 7 years. And if we're going to look at where we can get some return out of our money now, this is the sort of stuff that still makes money day after day.
It does, and it's a way to position ourselves more defensively in the event that market volatility
Yep.
continues. So we're in what I would describe as probably still a normal market cycle, but we've seen a correction in prices. We're seeing a lot more day-to-day volatility, and in addition to the defensive nature of consumer staples, we do like the opportunity in Europe. And this is a selective way to buy some European companies where we feel good about the sector, um, and add to Europe. We largely eliminated Europe from our portfolio or reduced it greatly and through most models from the beginning of the year, pre the Greek election, expecting a lot of volatility there. And we'll touch on that on another issue in terms
Yeah.
of what we feel about Europe, but specifically this does give us some European exposure. We expect that Europe is going to offer, on a relative basis, selectively more potential growth opportunities over the next 2 to 3 years versus the U.S., which we expect to still be stable, and still offer some opportunity, but we feel like there's more growth potential in some of the European equities, and this position helps us tap into that segment of the market.
And this is the thought process, we've had behind the scenes is quite often people will just look at the ETF and go, well, that's listed in the US, so it must be a US stock. But it's a US listed ETF with a lot of European companies in there that are driving a lot of their growth out of Asian consumption.
Well, we have the flexibility to allocate to positions across a variety of markets. For many clients, they'll find allocations in their portfolios that in fact are not U.S. listed positions. We may use positions that are listed on an international exchange like London or Hong Kong. And there are other consumer staples positions in other markets, but we specifically picked this position because of the global nature and the blended allocation of U.S., European, and other international names. And that was really why this position was out of our choices. Once we identified that consumer staples was an area of allocation and interest for us, that's really why we picked this specific position. Sometimes when people look at this, they notice it's certainly not actually the cheapest if you were just going on price. But it's large. There's a lot of liquidity here. Majoritively wide moat companies in terms of big global names,
Yep.
and companies that also have some growth exposure because of the global nature of this portfolio into emerging markets. And most clients will have seen that we don't hold much emerging market exposure right now. In fact, in advance of the September Fed meeting, we sold off some of the positions that we had, being concerned about how EM is going to perform in a rate environment. And so this is, again, a more defensive way for us to get exposure to some of those emerging economies through big blue chip names rather than trying to trade in local emerging markets.
So, like with all our portfolio ETFs, once we do so much research on why we buy them and get them into the portfolio, and we're looking at allocating or widening our allocation to this now, would there be a stage in which you'd want to get out of this?
Definitely. I mean, the allocation here. This is not something, and it's not really our mandate to make short-term allocations. Although sometimes we trade more frequently than others. But our view on this is really that this is likely a 2 to 3 year holding period. So that while we expect still that U.S. rates are going to rise, but in a very slow and steady manner, that Europe is going to continue on an expansionary policy in terms of trying to improve their economies. And during that period, we expect this to be a good place for our clients' money to be. Now, if those market conditions changed, this is a very large liquid position. We could easily switch this position, for example, a consumer staples position that was entirely U.S. if our view on Europe changed, or simply into another sector. But I think broadly our outlook on this is that this is likely to be a reasonable holding for the next 2 to 3 years, given the broad economic environment we expect.
Wonderful. Well, what we will do is we'll put this fact sheet up on the webpage so people can actually download it. You'll see on there that the fee is a little high. It's 0.47% or 0.48%. It's not that great. For people that are used to managed funds, these are still far cheaper, but that is a big reason why we've selected this one. We will look into the next edition to talk about another ETF, but that's been a really good, concise wrap up, and that's what we tend to do every month is just have a very quick snapshot of one ETF and talk to it further. So please, by all means, email in your questions. We're happy to answer them, and we'll see you next edition.
Great. Thanks,
Thank,
Todd.
thanks, Jess.